Our next guest is one of the top mortgage lenders in San Diego. Please welcome back to the show our good friend, Dale Entrekin.
There he is. Mr. Entrekin is here. Yeah, that was a home run ball from Matt Holliday, wasn't it?
Yeah, that was not one I caught, though.
Caught me. You got a piece of it.
Yeah, I got a piece of it, exactly. Got a piece of me, too, on the way out.
Great stuff, man. Hey, great to have you here. This is something that really people aren't talking about. You remember the last refinance boom when there was like every other commercial on any TV show you were watching was you got to refinance now, Ditech, all that stuff that was going on back then.
All the radio, too.
The radio. Every commercial break, there was something about refinancing. We're not hearing that stuff anymore. It's really interesting. I don't know why, because it seems to me like right now is a time where people could really save a lot of money refinancing because property values are up, rates are still low. That's kind of the perfect storm for refinancing. Is there any reason why people, I mean, has something changed?
I think there's probably a little bit of maybe a little bit of hesitancy with what had happened prior. With the big refi boom in 2005, 6, 7, all those years right when the market started to crash. I think people now are more geared towards thinking, I don't want to restart my loan. I don't want to do that. But I think right now is an excellent time because of the products that people got into initially on their loans with FHA, with mortgage insurance. Now I think there's just more opportunity.
Yeah. So if you have an FHA loan, you have mortgage insurance.
Yeah. For the life of the loan.
For the life of the loan. Mm-hmm. And so that mortgage insurance, isn't going to fall off once you get to 80% loan to value. Now with values up so much, so high, people can't believe it.
Yeah.
I mean, they don't believe it.
Well, we had recently a client buy a house. I think it closed in November up in Alpine, and it's up $40,000 in comps in the neighborhood with doing nothing to the property already this year. So that's not like standard across the industry, but there are great opportunities for people to get out. And he bought that house with a conventional loan, so lowering his rate wasn't really an option at this point. But looking at other people's scenarios when they bought with 3.5% down, you're able to get maybe even up to 20% in equity and refinance with no MI, no overlays, anything.
Yeah, right. So in other words, you can get a lower rate because the loan to value affects the rate. Yeah. So if you bought a home at 90% loan to value, but now you're at 80% because the value's gone up, you can take that adjustment off the table, which makes your rate lower, even if the rates have stayed the exact same.
Yeah, those are loan level price adjustments for Fannie Mae. And so with a Fannie Mae or Freddie Mac loan, they price you as the rate, as the loan to value based on your credit score. So if your credit score was 680 and you or 90% loan to value, you might have a much higher rate now if your credit improved and the market improved for you.
Right.
So you could have both. You could be really in the best of both worlds for yourself.
You could.
Yeah.
And that's just simply as a function of values going up.
Mm-hmm.
And the reason that I've noticed this, a lot of people lately have reached out to us doing Windless Listing, our reality show. They're casting a lot of people into that, and people think their home is worth what they bought it for, maybe plus or minus.
Yeah.
But when you take a look at it, it's like, well, you bought this thing a few years ago. I mean, the market's gone up a lot, and it could be 100,000 more.
Yeah,
than what they're thinking.
It's been really incredible with where values are. I mean, right now, I saw a statistic yesterday that showed the median home price in San Diego County is now at 2007 levels. So it's actually a little above that. So 2007 was kind of the start of the recession, and where the value started to come down a little bit. 2005 was the peak. We're a little ways off from 2005, but the values are pushing closer. And so if that's the level they're at, there's definitely equity to free up cash flow monthly, whether it's to pay off bills or just to lower your rate and term, potentially maybe go to a 15 or 20-year loan, cut off some years off your mortgage. Had a client talking about that the other day they were about 10 years into their mortgage. They didn't want to start over, but we could lower their payment significantly. So they were kind of debating whether or not. So we talked about a 20-year, and they could actually still lower their payment on a 20-year and not lose that time.
Yes. There's a whole bunch of different ways to save money on this thing. Kind of sticking with the same idea of just property values being higher, lowering the mortgage insurance, even if you get the same rate. Let's say you have 4%.
Yeah.
You qualify for 4% again with no mortgage insurance. Well, however much that mortgage insurance is pure savings to you because that comes out of your net. That's not tax deductible. So if you have $300 a month in mortgage insurance, you probably have to make $400 at your job in order to pay a month to pay for that mortgage insurance. So if you take that off, that $400 that you're making now, you could stick right in your 401k.
Yeah.
Or some sort of pre-tax retirement account, and you wouldn't notice any difference in your monthly cash flow. That's a really big savings opportunity for a lot of people. It could be college fund, retirement, whatever.
Absolutely. The other thing too is there's a lot of people that are kind of thinking in terms of, well, we have this, maybe an FHA rate that's 3 3/4 or something low, you know, kind of lower than what they could get on a conventional. Well, they may actually benefit both ways. They get a savings on the mortgage insurance piece when they refinance, but also get a little bit higher tax deduction because they get a little more interest on the mortgage too.
So you're talking about like someone who's got like a 375 FHA.
Or like a lower, like say somebody got 3.5, but they're refinancing a Fannie Mae that's just below 4% or around there or something. You're actually getting a little more tax deduction monthly or yearly. It's not a huge amount, but you're saving a little bit more yearly with it.
Yeah, I was going to say, so who would be a good candidate for refinancing right now?
At this point, it's anybody who's really bought a house in the last 4 or 5 years. Really, I mean, you're in a position where, you know, interest rates have dropped during that time. Right now, rates are as low as they've been. You know, we came up the last week or two in rates, come up a little bit, but it's still, I mean, the market's still significantly lower even than it has been in the last year. So, you know, it's like we talk about, don't miss the wave, don't miss this refinance wave, don't miss this refinance wave. There's coming an end of this refinance. Rates are so good, they kind of think it's going to be forever. It's not. At some point, rates will go up, and this is potentially the last opportunity to really save a significant amount.
And that might not even be the big aha situation. The big aha situation could be property values going down, because that makes such a big difference. In other words, for homeowners out there, you get to freeze your mortgage terms. It's like taking a picture. You get to freeze your mortgage terms based on right now. So if property values go down, if your home goes down in value $200,000 tomorrow, if you refinance today, your terms are fixed.
Yeah.
So it's sort of like, you know, you're hedging, because owning a home is a hedge anyway against, you know, the costs of living, right? It's your way to hedge and ultimately own, and then you don't have to make a payment one day. That's the idea. So if you're trying to do that as efficiently as possible, then you want to freeze it. When you get your mortgage, you're freezing. You're taking a picture. You want to take that picture when the things are as good as possible. When home values are really high and rates are really low, that's the perfect time to take that picture. So if you have mortgage insurance, you've got to look at this.
Well, and the other option too is if you have credit card debt, that's, I mean, the average interest rate on a credit card is like 13%, right? Because it's a riskier debt to the creditors. So it's 13.333, I think was the average. That means most people are probably like 20. If you have 20% credit or interest rates and 15% interest rates, those loans are going to be difficult to pay off if you have higher balances on them. If you got into a mortgage at 3.5 or 3 3/4 or somewhere in that range, you're just going to save yourself practical interest every month, right? And you're going to save that, and you should be able to save a significant amount because every month because you're spreading it over 30 years, and you're lowering that debt.
If you don't want to start your mortgage over again, which by the way you probably shouldn't, you should look at doing a lower term. You know, if you're 3 years into a loan, you know, do a 25-year amortization, or at least know what the payment is and amortize it yourself. Do a 20-year, do a 15-year. If you can pay, you know, about the same you pay now and lower the term, you're going to save so much money over time that it's crazy. I mean, there are tens of thousands of dollars, potentially hundreds of thousands of dollars, depending on how big your mortgage is. So lowering the term, lowering the mortgage insurance, these are all amazing opportunities for people to refinance now. I think it's great that we got the chance to talk about it today, because people just simply, it's just not out there like it once was. So there are people running around out there right now with 4.5%, 5.5%. I know, I've been talking to them.
Yeah.
They're out there. So we got to get the word out.
Well, that's what I had a client just recently. I was able to close his refinance, and he came into our office and he had a 6.5 interest rate. And I said, "Where have you been?"
I know, right?
You know, like, what have you been doing? How do you have a 6.5 rate?
Dale, thank you so much for your time today. I really appreciate it. Don't be that guy. If you got 6.5%, give Dale a call. He'll save you some money. Why not? Why pay the bank extra money if you don't have to? Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else, commercial free.